Today I want to talk about closing entries in accounting. But first, I want to touch on our basic accounting model that we use that states our assets equal our liabilities and our shareholders' equity. Now, all of those accounts are going to be affected by transactions that occur during our reporting period that either increase or decrease the account balance. Now, we refer to those increases and decreases as debits and credits, just depending on what type of account that we are using. And the shareholders' equity of that model has almost a sub account that is called the retained earnings. And that retained earnings account houses all of our temporary accounts, like our revenues, expenses, gains, losses, and dividends. And when we close out those accounts and do our closing entries, they all go to that retained earnings account. Now, the reason that we need to close out these accounts, or as we might call it, zero them out, is so that at the end of the reporting period, which is typically going to be 1 year for most companies, we need to have an accurate measure of our income during that period. And these closing entries help us do that. So, for example, if we have a rent expense as well as a rent revenue as well as a sales revenue, those have a positive credit balance. So in order to get them to zero, we are going to debit both of those accounts for the total amount they have in them, and then the total of those, however many accounts we have, are going to get credited to the retained earnings account. And that is going to increase our retained earnings account. And then with our expenses, any expense that we have, like a rent expense or advertising expense, those have a positive debit value, which means we are going to credit each of them, and that total amount is going to be debited to the retained earnings account. And that is going to decrease our retained earnings account. Now, the difference between that debit and credit amounts is going to be whatever our balance is at the end of the period. So whether it is positive or negative. And that amount is going to end up going on to our balance sheet at the end of the reporting period. And so that is the main reason why it is very important for us to have an accurate measure of our income.